Hey, Ole, what do you do?
I work in transaction services as an M&A advisor for Pricewaterhouse.
Oh, okay. That's good to know. Thanks.
You're welcome.
Lisa, what do you do?
I'm a graduate student in Dortmund.
Say it again.
I'm a graduate student in Dortmund.
Oh, a graduate student in Dortmund. Okay. Okay. What did you do before you were a graduate student?
Undergraduate.
Undergraduate student. Okay. Okay.
And an internship at KPMG.
Thank you. Okay. Good. Nice. Good, good. David, what do you do?
Yeah, I also study and also work within investments and alternatives.
Oh, investments and alternative investments?
Yeah, exactly.
Like what kind of investments? When you say alternatives, what do you mean?
Hedge funds, private equity funds, renewable energy, property financing. That spectrum.
So if somebody wanted to buy into a private equity fund, what would be the minimum amount that they could buy in for?
Yeah, like if you need to invest like through a fund of funds, it's about €100,000 or so, and then like the fund of funds for the attractive hedge funds or private equity funds are like a couple of million.
A couple of million. Okay.
Yeah.
And how long would they have to be locked up for if they did that?
Well, you aren't exactly locked up, but you just take a huge loss if you pull out ahead of time.
Okay.
But the investment period is about 2 years, and then the average holding period is about 10 to 12 years.
Okay. So you can get in and out, but there's
Yeah,
a penalty to get out early.
exactly. You
Okay.
need someone to buy your shares, and if you want to get out early, they know that you are needing the cash.
Okay. The only other people I've talked to in that line was an investment brokerage here in Boston, so in Cambridge, and they were, I think it was 50,000 was the minimum investment, but you could not touch your money for 2 years, period.
Okay.
Yeah, but so very illiquid.
Yeah,
All right,
exactly.
1031. We're back.
Exactly.
Okay. All right. So I think this is where we left off last time, is the slide that I'm sharing on my screen. I don't know if I'm way off on this, but I think this is about it, because I don't remember doing this example. And I do remember doing the stuff before it. So Andrea for sure knows. Andrea, is this where we left off? No?
We're in 7. That's the last one. Yeah.
This one.
Yeah, that was the last one.
Oh yeah. Okay. So we solved for the price at which
Yeah.
you had to underprice the issuance in order to keep the uninformed investor willing to play, to break even, and yet still provide them the sufficient profit for the informed investor to make money, right? So that was what we did there. Okay. All right. So seasoned equity offerings, what we mean just by that is that sometimes companies issue a second round of equity. So normally the way it works, the company issues their IPO, initial primary offering, and the shares go out to the public. And then after that, in the overly simplified version, the only people who participate in transactions are people like you and I, retail investors, institutional investors, but it's not the company anymore trading. That doesn't mean it can't trade, but normally what happens is the company no longer really trades in their own equities. So they sell shares the very first time and they raise capital that way, they get money that way. And then that's it. Those shares are gone and they no longer trade in their own stock. And then what happens is the secondary market takes over, and these other investors then trade shares amongst themselves. And when the company does well and goes up in value, whoever holds it obviously makes money, and vice versa. So there are 2 exceptions to what I just described. One is this SEO process. That SEO process says now at some point the company decides it needs to issue more equity. So when the company issues equity, they declare an amount that's authorized of shares, and they also then figure out how many they issue. Say that we come to market and we say we're authorized to issue 1 million shares, and let's say that we actually issue the 1 million. And now what that means is we can't issue any more shares without doing another issuance, and that would be this SEO. We have to go through the registration process with the SEC. We have to file all the paperwork again, and then we come out and issue more shares. So what happens to the people that bought shares the first time? Well, as soon as we say that we're going to do an SEO, the people that hold the first round of shares are about to get diluted, and they know that, meaning, if there were 1,000 shares before and we're about to issue another 100 shares, those first 1,000, which had, I don't know if I can, I'm not explaining this very well, but those first 1,000 shares owned 100% of the business. And so each share was worth 0.1% of the assets, or claim to the assets. When we issue this next 100 shares, though, now those original 1,000 shares only have a claim to 1,011 hundredths, or 0.09 portion, 0.09% of the business instead of 0.1%. Okay, so it dilutes a little bit, meaning there's more shares outstanding. So each share that's outstanding is worth a little less. If you're still struggling to get what I'm saying here, they take the same sized pizza and cut it into more pieces. Instead of 1,000 pieces, there's 1,100 pieces. How do you get there? We didn't get a bigger pizza. The assets are still the same. So what happens is each piece of pizza has to get a little bit smaller. And so now all of a sudden, everybody's slice of pizza it ends up having to be a little bit smaller than it was. So that's what an SEO does. There's really huge negative signaling that happens here. If a company has to come out and raise additional equity, it will be questioned by the market. It will be viewed badly by the shares, owners that are already out there. And it will be very poorly received. So SEOs are usually, the announcement of an SEO is met with usually very bad responses from the market, unless there is a completely believable story of why the company needs to do the SEO and how that's going to be good for everybody. And the example I think I gave last week, but was the gold mining company that we own stock in Colorado, and back at Michigan State. I didn't own it, but we managed that fund that did. And when the gold mining company came out and said, we're going to issue additional equity, but that will allow us to tap into a new reserve of gold that will actually be better for everybody. So it will improve the wealth of the initial investors. And so in that case, the market did not drop too badly, but then they came out and asked for more, and then they came out again a third time and asked for more. And then by then the company had pretty much collapsed. But so that's the first piece. The other exception to what I described a minute ago is treasury shares. So there's 1 million shares authorized, but we've only issued 900,000 shares. And that means that we could still sell 100,000 shares out of our own treasury to raise capital on a short-term basis if we needed to, or if we felt that the stock was overpriced. And we could also go back and buy shares when we do a share buyback program. We don't have to retire those shares. So there's 1 million shares available. We buy another 100,000 shares in the market when things are going well. Now there's only 800,000 outstanding, and we could issue now up to 200,000 if we needed to. Imagine for a second how Massey Ferguson could have used an SEO to try to raise enough capital to retire debt, or before it got out of, at the end, they could not have, there was just not enough left, but they could have done that. Or they could have earlier also, had they authorized more shares, but not necessarily issued them, they could have issued more shares, raising additional capital without having to even do the SEO. That would be another option. So SEOs are just secondary options, secondary offerings, and they because of dilution impact prices negatively. And it works a little bit like this too. So imagine that there's two companies, company A and company B. Company A, it might be worth 90 and it might be worth 70. We're not 100% sure because there's an informational asymmetry and we're not positive. We think that it's 50-50 odds, 50% probability that the company's really worth 90 and a 50% probability the company's worth 70. And we're going to compare that to another company, company B, that is the same in that regard. 50% probability being worth 90, 50% probability of being worth 70. All right. So what's the expected value of each? Well, it's 0.5 times 90 plus 0.5 times 70 is $80. So we should think the fair value for either of these shares right now would be $80. Now, we assume that the manager really knows what the value of the company is, but honestly, having been somebody trading treasury shares in Kellogg's treasury, we don't really know what the value is. We might have some ideas, but the problem is we might have perfect information about what's happening inside of our company, but we also don't have perfect information on what's happening with the competition. And I remember we were going to launch a cereal called Smart Start. It's still out there, but that Smart Start cereal we felt was going to like literally just be this huge growth vehicle that was going to completely take over the market. And it was a good cereal, but it wasn't that good of a cereal. But we didn't know what the competition was doing, and they countered that move very effectively, keeping us from really launching this great product. So my point is, I don't believe that the managers know the true value of the company. They may have some ideas if it's undervalued or overvalued. They might know the premieres are going to be bad. They might believe that they've got it figured out how to monetize ad revenue on a website, a search engine. In any of these cases, we know that there was some inside information that the managers would have a good indication of. I just don't think it's perfect knowledge. So imagine for a second, though, the market expects both of these shares to be worth $80. The company A leadership knows the shares are really worth 90, and the company B leadership knows the shares are really worth 70. So who's going to sell? Well, at $80, if the market's offering 80 and company A knows their shares are really worth 90, they'll never sell. Why would they sell for less than they're worth? And that kind of, the fact that they're unwilling to sell tells you it's worth more. The simple fact that company B is willing to sell shares for $80 a share must indicate then that the shares aren't really worth $80, or they wouldn't be willing to sell. So therefore, what we can conclude then is that the shares won't sell for $80. So if you like the logic behind this, there's a paper by George Akerlof called A Market for Lemons. And that paper is a Nobel Prize winning paper. And so I can, like, here, I'll pull it up. So you take a screenshot if you want to see it, but I need a window here. So this paper here, Market for Lemons by Akerlof, cited 37,000 times. Remember, we talked about number of citations being an indication of kind of how important. 37,000 is a pretty good number. And what he really does is he looks at cars and he says the seller of the car knows if the true value of the car is higher or lower than the current selling price, and the seller of the car will never agree to sell for a loss. So therefore, the simple fact that the car is for sale at a particular price means that you should never buy it, because it would never sell for that price if it was actually worth it. It's a little bit like the winner's curse. It's not exactly the winner's curse, but in this case, what we're talking about is the idea that people won't sell something for a price below what it's actually worth. Now, we know that there could be liquidity reasons that a company would sell at a discount, or there could be other reasons that might cause a person to sell something for less than the true value. But in general, if a company is willing to issue shares at a particular price, there's an indication that maybe the upside is not too huge at the very least. So the idea here being that company B will gladly sell the $70 valued shares for $80, and company A will not sell $90 valued shares for $80 because they're getting ripped off. So I always felt that way a little bit. The market knows that, and because the market knows that, we see that when companies do share buyback programs, that the market responds favorably. Part of that is because there's this anti-dilution, concentration effect that's happening, but part of that is also the signal that says the company realizes that these shares are still valuable at their current price level, so therefore we should all be buying them. And so the signal to the market is another piece of the story. Okay. So there's no credible way for company A to convince the market that the shares are really worth $90, and so they just won't sell. And that's the idea of Market for Lemons. In fact, Market for Lemons does something like what we did in the, on slide 7 or whatever. In this case, where we solved for a price at which the market would clear, Market for Lemons does that from an analytical economics perspective, and shows at what discount all cars must sell in order to make people willing to buy cars that they don't know if they're actually any good or not. And so it shows how this informational asymmetry keeps people from paying full price for assets. And hence it also actually is then the reason that warranties exist. And so, because then you'll be willing to pay more, because even if it's not in perfect condition, you know that it will be put back into perfect condition or something. So
sorry to interrupt.
Yeah,
I know you just mentioned that share buybacks are normally like a positive thing.
Yep.
I guess the company realizes that they're like doing really well, they buy the back and gets investors excited. And this kind of ties back into something, I forget who said it earlier, but when a company goes public and they have like their hold up period,
yeah.
Isn't it a horrible sign that like as soon as that hold up period ends, the CEO or whoever just starts dumping shares? Like, didn't that happen with Snapchat or something?
I don't know if it happened with Snapchat, but Nick might know that piece. But it's definitely, whenever an insider sells, it's definitely like a negative sign to the market, because this person is willing to sell at this price. So they must know that the price is not actually worth that much, unless they can accompany that with some kind of like, they're going through a divorce and they have to liquidate the estate and things like that. But short of those kind of things, it's bad. Nick, do you have thoughts on this lockup period flipping stock as soon as it ends? Could be negative signal, or it could be mandate based on the financial plan. Okay. And so the company can file, when you say financial plan, Nick, you mean the fact that the company can file a plan with the SEC that says we're going to liquidate X number of shares on particular at a certain frequency, like every quarter, every month. And so as long as it's a part of that predetermined financial plan, people believe it's not just indicative of new news. Is that what you're saying?
Yeah, it's I forgot the name of the filing, but like it's a plan that's on file for like the CEO and so on and so forth. But like the smaller insiders, a lot of them have all their wealth tied up in the company, so it's smart for them or prudent for them at like post Enron to like diversify. So it could be a positive signal, it could be a negative signal, but like I wouldn't read too much into it. Because you think about like the CEO of Moderna, right? He was selling shares, okay, when the stock was like at 45, and he was getting all this flack because he had a predetermined plan, okay, he was trying to explain to the market, and he thought that everybody thought that the drug wouldn't work, right? And now the stock is like $360, right? So like obviously he kicks himself in the butt for doing it, but it just happens to be.
So in Chris, I know that there's research that shows insider sales, insiders are like right 86% of the time if they're not on a plan. So like we don't know necessarily if they know exactly how much they're right by, but so people listen to insiders when they do sell without that being part of a pre-disclosed plan. Yeah. Brendan, you had your hand up. I'm sorry.
Yeah, I mean, Nick summed it up really well. And I think I think you would probably need to dig into it a little deeper. Chris, if you put yourself in the perspective of an executive, well, the executive could be 55 or 60 years old. They basically their entire life could have been invested in this company. And so all of a sudden, they have this liquidity event, and let's say they're worth $100 million, and they decide to sell $7 to $10 million worth of their stake in the company just to protect their nest egg, but they still have, if you think about it, and this is just a hypothetical case, $90 to $93 million still tied up in the stock. To me, I don't view that as a negative sign from a high level executive. They're just trying to protect a portion of their assets, and they still might have a highly significant percentage of their net worth tied up in the company. So I think it would depend on a case by case basis. And if you saw an individual unload half or their entire position, definitely. But if it's just a small percentage of their holdings, I like Nick said, I wouldn't hold it against them.
That's a really good point, Brendan. The other piece that I would just add to that made me think of is you can also look and see if 6 registered insiders are all selling significant portions of shares, that's probably a pretty bad sign, right? If it's one person, that may be just individual specific, right? We had when I was at Ford, anytime an individual would sell, then Bill Ford Jr. would buy to offset, so that he felt that it kept the signal to the market neutral. And it turned out it didn't take the market that long to realize that Bill Ford almost always got it wrong. So I mean, like a Bill Ford buy was actually a sell, that was a sell signal kind of a thing. But when we had like 6 different people all selling shares together, that was a strong signal to the market that maybe we were overvalued. So it just depends, I guess, on how much of your wealth you're selling and how many other people are following suit. Both of those things. That's good. Julia, was your hand was up? Somebody else?
Yeah, not really urgent, but just a nod to why those reportings are so important, right? That it's not just what happens, but why it happens. I remember looking, I was part of a mutually held bank that went public. So it was really, really tiny, but was part of that IPO and in the boardroom when those decisions were made, and super interesting process. But we as employees, even after it was public, would look at those those insider sales.
I would imagine also that, you know, it's important to have a nice press release that accompanies any kind of transaction along those lines that just explains it, right? So, and if there's a story that makes some sense, fine. But if there's not, then okay, that maybe it's more sketchy. Good. Okay, so all right, so implications of this idea that insiders know what something's worth and that the market won't pay what the insider is willing to sell it for, because that wouldn't ever clear if it was actually worth that much. The market for lemons argument is, it explains why companies should be more willing to like actually take out debt. So a company that takes out debt doesn't have to worry about this problem. And so if they can actually access a debt market and they can raise capital through debt instead of equity, they don't have to worry about their equity actually being discounted, and therefore there's not this loss in value through liquidating. The same argument applies then for a preference for retained earnings. In other words, even a debt issuance might still contain a negative signal. Again, it might actually contain a positive signal, but it might contain a negative signal. And so the companies, rather than issuing any kind of security, would rather fund their operations through operations or expand their operations through operations. So the retained earnings of the business become the primary choice of capital, so as a source of capital to expand the business. And then we move to debt, and then we move to ultimately equity. And so what we talk about there then is it leads to something called pecking order theory. And pecking order theory just says there's an order that firms will use to raise capital. And if you think back to the Massey Ferguson case, they exhausted all of their operating cash flows, and so then they supplemented that and continued to try to buy growth through issuing debt. And then they essentially took on so much debt that they never did get to raising equity, or issuing equity. This also indicates that there's a value to having slack cash. Slack cash means excess cash that you don't need for any reason. And I've talked before about that being a bad thing, but in this particular case, it's a good thing. With that, when I talked about it before, I did say, if you're the kind of a company that runs into opportunities to buy, make an acquisition or invest in a new product, or you have a lot of good projects that frequently pop up, then holding excess cash is not a problem. And that's the idea here. Holding some excess cash, or leaving your line of credit, available so that you can extend it or something like that, might be a way that you can raise capital in the short term and not have to issue any new securities. And it allows you to take advantage of some temporary opportunity that you might be faced with. And then lastly, missing out on missing out on positive NPV projects because you can't raise the financing is actually super expensive. So, gee, I have a project that would yield 20%, but I can't fund it anyhow. And now I can't afford to do the project. Well, then the effective opportunity cost is 20% lost. And that's a lot. You'd be able to pay a lot of debt and still have it be a positive NPV project. So having excess cash or access to a line of credit can be useful at times. All right. So the market, when you do an SEO on average, the market reacts with a 3% drop in share price. If you issue convertibles, it responds with a 2% drop in share price. A convertible is just like, imagine a bond that you can convert into equity, or preferred stock that can be converted into something. If you issue a convertible, it also responds as a 2% price drop on average, but that's not by any stretch all companies just drop 2%. Some drop 2%, some drop 5%, some actually might go up. Again, I think it depends a lot on the story that is being conveyed to the market at the time that these announcements are happening. If you issue public bonds, that's viewed as neutral. And if you go out and borrow money from a bank, that's viewed as a favorable thing. And typically stocks go up by 2% when that announcement happens. So empirical evidence on repurchases, stock price reactions of 8 to 17% increases at the announcement that the firm's going to repurchase their shares with a tender offer. Tender offer means that it's a big offer. They come out to the market and say, well, we're going to buy, 1 million shares at a high price. And there's usually a price premium associated with the tender. And so that tender offer is a big signal. But if you just come out and say, we're going to buy shares back in the open market, then that's associated with a 2 to 3% price increase. And that's consistent with still what we see today. And it's kind of what you'd imagine to see. Unfortunately, CFOs learned this, and then they began to take advantage of this a little bit. And it became a way to bump your stock price up, because if you're paid in, say, stock options, and you want your stock price to go up, and you know that on average, the stock market responds favorably when you announce a firm buyback, then it might make you more likely to announce buybacks, is all I'm saying. And obviously tenders are bigger than just normal market operation, repurchase programs. So those are going to be associated with bigger movements. Just the announcement of a new financing strategy can really trigger share price movements up or down. The size of the announcement is too large to be explained purely by the cost or benefit of the announcement. In other words, I announce I'm going to take on a bunch of new debt. And if you took TCD and you looked at that as being the benefit of this new debt I'm going to take on, it would be very reasonable that actually my share price, my market cap changes by even more than just TCD. And the reason that academics offer for that then is that it's because it also contains additional information, which surely it contains information. It's just not always clear exactly what that information is. So, yeah, so you just need to be thinking about the signal that you're sending to the market. Okay. Why would managers be reluctant to disclose information? Well, first off, you have an incentive as a manager. So you're the CFO and there's some bad news coming. And you definitely want to hold off on disclosing that bad news as long as you can, because when you announce the bad news, share price is probably going to fall because there's bad news coming out, and you don't want to be, you would like that to happen as late as possible. I'm not sure I agree with that. I think having a lot of transparency actually is a good thing. So I'm overstating some of these a little bit, but you might have some incentive to delay bad news. You also might disclose information that could be valuable to the competition, which is one of the Google issues with having to disclose. I think I said this the other day too. I think I covered this because I think I talked about Elon Musk making a lot of comments that are like on Twitter that, to the point where the SEC has said essentially stop doing that, and he just continues to do that, right? So finally, how can markets misinterpret the announcements? Imagine for a second that you have said you're going to cut your dividend, and you don't tell anybody why. That probably is going to be viewed as you're in some financial difficulty, that you don't have the excess cash right now available to pay the dividend. But the reality of it might just be a new change in dividend policy because you're going to move to a share repurchase program instead. So you need to come out and say, while we're cutting dividends, we're also going to increase our share buyback program so that we maintain share price. You cutting your dividend could signal that you have some really great investment opportunities that the market doesn't even know about, but they probably won't necessarily interpret that, especially if you don't tell them what these great opportunities are. Or finally, you could cut the dividend just because your earnings are poor, and the market won't know which of these. One of these should be met favorably, one should be met negatively, and one arguably maybe slightly favorably or at least neutrally, which is the whole idea that the dividends are tax inefficient. So two of these might actually be good news, and yet your stock price might fall if you're not clear. So one of the things I learned, so when I was at Kellogg, we had 4 treasury managers in the treasury, and there was the treasurer, the CFO, and 4 of us in the treasury, and we did everything that was for the entire treasury. So I owned cash and I owned foreign currency exchange. Those were the 2 things I owned. Another guy owned the pension fund, and I helped with the pension fund, but I was not the primary owner of the pension fund. And we kind of all helped with one of the other things so that there was natural redundancy. But so my 2 things were cash and foreign currency. The guy on the desk next to mine, his name was Rich, and Rich had investor relations. So John had a different John than you've heard of before, but John had the pension fund, and then we had another guy who had like all the cash clearing, like all of the banking relationships, like specifically payment processing and all that kind of stuff. Whereas I had the cash forecasting side of it. Anyway, the whole point is when we would have quarterly announcements and we would be talking to the investors and they would ask questions, the first conference call I was on, I remember, I don't even remember what I said, but I remember as I said, whatever I said, the treasurer turning, he was in a glass office and I was in a cubicle outside of his office. And he was looking out the window at the river. And as I spoke, he turned and glared at me like, stop talking. Like you're conveying information you should not be sharing with the market right now. And as soon as we got off that, jokingly, we all had Bloomberg terminals on our desk. And jokingly, he was saying, as you were talking, I was watching negative ticks piling up. So like kind of a thing. So the point is, I'm not the guy that should talk to your capital markets people. I'm not that kind of smooth. I'm a little clunkier than that. But and so the point is, how you do that matters. Having somebody, Rich was super smooth. He could sell ice cream to Eskimos. He was like F. Ross Johnson kind of a thing. And so Rich was a great guy for that, but he couldn't forecast cash. But anyway, that's a different conversation. Okay. More incentive issues with information asymmetries. So, here it says managers know that short run stock prices will be affected by the market's perception of the information. Of course, we know that as managers, that what I say to the market will affect our stock prices. But I also think that we try to manage that message, and we don't just allow it to be random. And this information asymmetry makes it worse. The more public information there is out there about what we're doing or what we are or our products means that the market can better interpret what we're saying. And the more closed off or secretive we are, the more they have to try to infer things. And when you make people infer things is when it gets a little bit dangerous. So why would managers care about the short run? So compensation considerations, career considerations, maybe they're worried about a takeover. It could affect the deals that you sign with, either new customers or vendors. And so the compensation considerations I'll give you, I've probably mentioned this before. This is how we know the class should be over now, because I'm now retelling stories, right? Once you get to the point where you've told all the stories, I think that then it's time to be done with the class. I just dumped water on myself, but it's smooth, right? Like, can you see me doing that during an earnings announcement? Anyway, what I was going to say is compensation considerations. I was at Ford. We got a brand new CEO. The brand new CEO came in and said, stop working overtime, period. No more overtime for anybody. And then at product development, they didn't start any new projects. In the first year that person was the CEO, his name was Jack Nasser back then, the stock price went up. And it went up because all of a sudden we had better cash flows than we've ever had. And our earnings were actually really solid. And so the market looked at the financial information we released and stock prices went up because suddenly Jack had fixed the business. And the next year, even more so. And then the next year, you typically, if you go to the Detroit Auto Show, so there's an auto show in Detroit, I think is in Germany, is it Stuttgart? Lisa, is there a big auto show in Stuttgart?
There's Stuttgart and there's Geneva.
Okay, but Geneva is not in Germany.
No. In Europe, those are the big two.
I'm just giving you a hard time, but I think Stuttgart is to me the automotive kind of capital of Germany, right? I mean, other people in Munich BMW people won't agree with me, but the rest of the people I think Stuttgart. But so my point is, at the auto show every year, when you go, the companies present their new products that are in the pipeline. And that third year, we were standing in the arena in Detroit with our cars, the lineups there, and there was no new prototype to show everybody that was in year 3. There was no, this is the forward-looking view of what's coming next. And people started to get really concerned. And then what they found out is we had stopped doing R&D completely and hadn't done it for 2 years. And there were no new products in the pipeline. And that's a horrible message. And now they could understand why all of a sudden we had all these great earnings and all these great cash flows, but it's because we stopped reinvesting it back into the business. And he didn't make it to the next auto show. And by then we had a new product beginning to be started up again and stuff like that. But why did he do that? His compensation was so much stacked toward options that he made tens or maybe even hundreds of millions of dollars by mismanaging the company, sending the wrong signals in the short term, driving the share price up because that was how his compensation was structured. So that's my only point with this is, managers might do the wrong thing for the wrong reason. And that could be, they might want to be remembered as a, from a career perspective, the person that saved the company, or compensation wise, because they're paid with options or whatever else. Okay. So signaling is what we're talking about a lot of here. So financial information obviously is an important thing, and how you convey it to the market matters. Signaling can be costly and inefficient. So this is the dumbest example in any slide ever. And every time I get to the slide, I say, I'm going to cut this slide as soon as I get out of class today, and then I never do. But so imagine that you're a recruiter for the CIA, and we all know the CIA would be a risky job, and you could be captured or tortured. Honoree, if you just to keep you out of trouble, you could be maybe being recruiting for the KGB. Okay. Oh, you hit something. Did you just stop recording? Like, I don't know. I'm just kidding. Okay. Anyway, just you know what the CIA is. So you're recruiting for the CIA. Everybody knows that it's a risky job. You could be captured, you could be tortured, you could be killed, whatever else. And so it's really important that if you were going to be a spy, you can actually withstand torture and not tell all your secrets. This is so stupid. Anyway, so two different people apply for the job. In the recruiting process, you sit down and you give them each a pair of scissors and ask them to cut off a finger to show how tough they are, that they can withstand torture. And person A just refuses. And person B actually slowly is highlighted. This is not my slide, but anyway, slowly cuts their finger off in front of you to show how tough they are. And so who would you hire? And the whole point here obviously is there's a signal here. And the signal from person B is, I can do this. I'm the person that you want to put in this risky situation. I think we all realize that person also has mental issues and probably shouldn't be trusted with secret information. And lastly, they wouldn't be able to get a clearance because they have a disqualifying physical, limitation now that they didn't have before. So it's a really, really terrible example, but you get the idea. The point is, in order for a signal to carry meaning, it has to have a cost. In this case, the cost is the person's finger. But the point is, if I stand up there in front of you and tell you everything's going great, yet another great quarter, there's no cost there. But when I stand up in front of you and say, we're having troubles with this product or some other product or whatever else, then I'm being honest, I'm being candid, and obviously stock price will respond a little bit negatively. Now you could probably believe that because there's a cost to the message. That's the whole point. Brendan thinks they call it something else in Russia. They probably do. I'm just going to let it go for now. That's fine. All right. So person B is a better bet because they can withstand torture, but obviously they've signaled strongly, but anyway, that's, all else equal, missing a finger makes you a worse spy. And yet it might be a really great way to signal that you should be hired as a spy. It's stupid. All right. So I'm going to take that slide out, but yet it'll still be there in the fall. Okay. Interpreting corporate announcements. So the market's reaction to the announcements includes the assessment of the announcement itself. So what is the company telling you that they're going to do? And is it the right decision? And then B, what supporting information is announced that pertains to these future prospects? So can I glean something from this? So are they doing the right thing with this acquisition? And then B, what are the potential synergies or cash implications or profit implications for this new announcement that they've made? And so that's the whole point there. Insider sales. And so we were talking about this a minute ago. So insiders or large block holders or founders may want to keep the share price as high as possible. And yet, as Brendan and Nick both pointed out, they might want to sell some of their shares for other reasons. So how do you feel about the following strategy? You just tell the market that your shares are undervalued and the company is great while selling all of your shares. And the answer is, that's going to be really confusing to the market. And so this gets back to Nick's point about set up a plan. I'm selling shares because I have a personal need for liquidity or diversifying my portfolio, or I'm going through a divorce or whatever else. If Bill Gates starts selling shares right now, you get what's going on, right? Like that would make some sense. But you probably want to carry that. You probably want that announcement to carry with it some information about what's happening, because if the person just starts selling without any conversation, that's a negative signal. All right, so how can you signal that shares are not overvalued? Well, go out and buy more shares. That tells the market that you're putting your money where your mouth is and the company really is undervalued. Just choose not to sell any shares in the first place, or sell shares in a way that indicates that the trades have nothing to do with inside information. Like don't sell, right before an earnings announcement, So Instead, selling on a pre-disclosed program of how often and how much you're going to sell and sticking to that program, then like Nick gave the example about the person from Moderna, is a good way to do this. Now you know what he's doing and you don't worry anymore that there's negative information contained in that announcement. All right, the cost of new issues. So we talked about the IPO process, and even in the case, they were able to do the IPO at like 2.75% of the total issuance for fees for the bank. So what kind of fees are associated with new issues? Number one is the underwriter spread. So the difference between what they're going to pay you for the shares and what they're going to sell the shares for. That underwriter spread is how much they're making in a firm commitment arrangement. That's the compensation they get for bearing this risk. Other direct expenses like printing, travel, communications, whatever other costs are associated with this, it's a giant transaction. Transactions have costs. Indirect costs, though, I will say actually can be kind of huge. So when I was doing the bond issuance at Kellogg, one of the things that it just consumed us, and it caused us to stop focusing as much on our normal day-to-day responsibilities, because we were always dealing with this stupid bond issuance, which was taking too much time. And so it caused us to be distracted from maybe running the business day to day. That's a cost. Surely if you're doing a new IPO, imagine the distraction that would be involved there and the number of hours of overtime that would be needed and things like that. I would imagine it would be pretty huge. Incorrect pricing. In other words, if the IPO is underpriced, that's a cost because you're not getting as much money for your shares as you could have gotten or should have gotten because they were underpriced during the IPO process. And then lastly, Nick earlier mentioned something about a green shoe provision, and the green shoe provision just says, so I think he said about the VC firms, but a green shoe provision just says that there are additional shares available to both usually the bankers as well as the founders, and they can sell even more shares. So there's something like, in this case, 15% is what it says here. I don't know, 15, 10, something like that is usually what you see. And you can sell more than the number of shares that were initially listed. As a part of this green shoe provision, I could sell some of those shares if things are going really well and the share price is up, and it's a way that they can capitalize on a good IPO, which again causes you to want to make sure that it's the firm commitment price is low enough that it'll issue with a positive trajectory. Then selling some of your green shoe allotment can be a way to raise additional funds. What do we think about these? We know that there are economies of scale. So imagine, oh, Brendan, go ahead.
I do have a quick question. Is the green shoe allotment of stock, does that create dilution, or does it come from treasury shares, or how does that work? Is that negative when they start adding more shares onto the offering?
Nick, you look like you want to answer this.
Yeah, so the green shoe comes from insiders, okay? And, because basically when you do shares, it's like, authorized shares to sell, so on and so forth, how many are outstanding, how many they float, okay? But like a green shoe is there only if there's so much demand and it's oversubscribed that they'll put more shares out on the market. That makes sense? But it's actually a positive thing in a sense because there's so much demand for the stock as opposed to them doing a secondary where there's no demand for the stock potentially.
They still have to be authorized, just not issued in the first place, right?
Yeah, they have to be authorized, okay? And whether they issue them or not, and it also could be insiders that are selling blocks, right? And so like hey, I was granted these shares, internally, 10 years ago. I want to monetize it. They'll sell the block. That goes into the green shoe.
Cool. Thank you, Nick.
Thank you.
So economies of scale. So you can imagine that, for a large company that there's going to be large costs associated, but for a small company, those costs would be even worse on a percentage basis. It still takes a lot of attorney time. It's not a linear relationship. As I go from a $100 million company to $1 billion company to $100 billion company, it's not like each takes 100 times more hours. It's actually, there's a much less efficient use of resources on a small IPO than there would be on a big IPO. Also, on a small IPO, there's more uncertainty around the IPO, so there's probably going to be more underpricing. And so that means that there's more money left on the table by the company who's doing the issuance. Direct cost estimates here shows IPS 5 to 11%. I think what we saw in the case was like 6 or 8%, something like that. So consistent with those for an IPO. And the underpricing tends to be the biggest cost of all of these, because if it's underpriced by 10% and then you have direct costs of 6%, that you could be giving away 16% of the value of the firm just to go through this process. Okay, so this is I don't know, I think it's interesting. I don't know, every time I get to this slide, I always think I'm going to do more with this slide, and then I never do until the next semester when I get to the slide again. So it's the opposite of the SPY one. There's a study where they went out and looked at a 5-year period of following the IPO process, and the stocks who had IPO'd underperformed comparable stocks who did not IPO. And so kind of strange, right? So in other words, if you were part of a company who had already IPO'd or who had not yet IPO'd, in either case, but I guess it's, then you compare prices down the road and you look at implied compound annual growth rates in the equity prices. The companies who do the IPO end up stagnant for some period of time, which suggests then that in fact that first day initial euphoria that hits may be actually too much. And so it gets ahead of itself, and it takes a while. The company becomes stagnant a little bit for a while until the price actually settles. Doesn't necessarily settle down, but until the earnings and everything else catch up with that initial price and then begin to carry it forward again. So the argument here would be, if you can get in on the IPO, first off, remember the winner's curse, it's probably a bad deal. But if you could, research would suggest you would do well to take part in an IPO if you could get into it. And then secondly, you would do well to sell your IPO quickly after the IPO issues in order to take your money out and put it someplace else, which goes right back to what we said before about why would a large institutional investor be interested in being involved in the IPO? And the answer would be to flip it and make a pretty good short-term gain if they could. Issuing bonds is a similar process. You still have to hire an investment banker. You still have to register the issuance with the SEC. You still have to pick the timing of the issuance. You can do something called shelf registration, which just means essentially it's you set the issuance up, but you don't pick the time or the price yet, or even the investment banker. And so it's kind of, you can only do it with bonds, but you set the issuance up and you're like, all right, here's what we're going to do. And then you can still have the flexibility to, for example, come up with a price later or come up with a timing later once you know what market conditions are and if they favors you. So that's the idea of shelf registration around debt. We had the opposite experience. Only once did I issue a bond, and we delayed that thing multiple times because we felt that the time was never right. So okay. The private placement market is an alternative to going public with these things. And private placement, what we mean there is we could really mean debt, or we could mean private equity. But in this case, we're talking about selling some debt to a group of investors. So you see all the time Warren Buffett, doing private lending arrangements and stuff like that for other companies. GE Capital used to do this a lot before it got spun off. I don't know. I assume it still exists. I don't even know if it still exists, but I don't have students that work there anymore, so I don't know. And anyway, so you issue debt, but instead of doing a public issuance of a bond, you go to a large institutional investor who can diversify the portfolio broadly enough, like an insurance company or a pension fund, and you borrow from them directly. And in exchange, they get a rate that is better than they would get on buying bonds. And you might actually get a rate that would, after transactions costs, be lower for you than it would cost to issue bonds. So essentially, you just cut the investment banker out. So, if you include your investment banking fees, you might have had to pay this much to go public, and the other investor might have only made this much on buying the public bonds, and the investment banker kept the spread. And now what we do is collapse that spread a little bit. They get a little better rate than they would by buying from the open market. And I save on transaction costs, effectively making my yield a little bit lower than it would be through a public issuance. And so that's an easier way to do this. The problem is it's not so liquid, and you can resell it, but it's not so liquid, which means that now we're back to an illiquidity premium again, talking about how much more do I need if I can't sell my asset and convert it to cash. And so Rule 144A down at the bottom says qualified institutional buyers are allowed to trade in unregistered securities. So this is exactly the private equity, private debt markets that I'm talking about. So they can invest in private transactions, which, because two different institutional investors can trade, so this, debt, this private placement of debt, it allows for increased liquidity, but it's nowhere near as much as would be in an open debt market setting, because it's still going to be much less liquid than that. So there you go. Venture capital, slide 26, 7, 8, 9. I think that's the end. We're not going to take 3 hours on Thursday. I kind of want to just leave venture capital for Thursday. I'm kind of tired. Yeah. Are we all good if we just call it 10 minutes early? Yeah. You've all been working hard. I'm sure that you don't mind that at all, right? Okay. So we'll stop here then. We'll finish the slides up on Thursday. I think we're right where we want to be timeline wise. Yeah, I think that's about all there is to it. So I will see you guys on Thursday. If you have any questions or you need something, I have office hours tonight. If you want to come find me, I've talked to several people over the weekend, made time to talk to folks. So if you need something, let me know. And otherwise, I will see you Thursday.
Hey, Greg, can you stay on for a sec?
Absolutely. Everybody else is free to go.